Good day, fellow investors. In the past, we discussed how we are very likely in a stock market bubble, and that especially on the basis of Jeremy Grantham's stock market bubble predictions, where he is comparing the current environment to the Japanese stock market bubble in the 1990s and, of course, the dot-com bubble. And now it's finally happening. Stocks are down, softer in 2022, so we can say that the bubble is deflating, and exactly as Grantham predicted it. First, the hot stocks crash, and then others. But the warnings haven't stopped now that we are a little bit down. Actually, the warnings are now emphasized to be even more careful and don't rush to buy the dip. Ray Dalio just gave an interview at Davos, and I really like his summary, and I want to discuss that in this video, and then also dig into his message to invest in real assets, so something that's going to protect you from inflation. The first thing he shared are three factors: that there is more money printing than ever in the current, of course, long-term debt cycle, there is rising internal conflict and rising of other great powers across the world that dispute the leading positions of what we now call the developed world. And there was a direct question: can the Fed reduce demand without breaking the back of the economy? The answer was no, and he explained it through interest rates and how it is not possible to increase rates to provide real returns to investors. And we'll explain what does it mean a life without real returns. So interest rates have been 0, and now those are close to 1, the effective federal funds interest rate, but inflation is 8%. So the Fed needs to push interest rates higher and higher, and we don't know how much higher in order to curb or to keep inflation at the range of 2% that they always hope for. And Dalio says that there is a surprise coming: cash, bonds, equities, that there will be a massive sell-off. Everybody will sell. Foreigners, the Fed, the government, individuals will sell debt, and that will lead to big issues. And we can already see a change in the 10-year treasury. So as more people are selling debt than buying debt, then the yield of that debt needs to go up to satisfy, to find a balance between demand and supply. So the government is selling, everyone is selling with higher interest rates. Now it's already at close to 3%, 2.76 as I'm filming this, but it was much lower just a while ago. And why will everyone sell the debt? Because the real returns are still negative. The yield on the US Treasury should be 8% just to be at 0 now. So with inflation at 8%, the yield should not be at 2.76 but should be at 8 to cover for this spread between nominal and real returns, because anyone investing now in the treasury is losing purchasing power despite the 3% yield, which means there will be a lot of sellers, because why would you own something where you are guaranteed to lose? And here we see CalPERS, the pension fund that has 27% of their portfolio into fixed income, into bonds, where they are most likely losing on a real purchasing power basis. Thus, pension funds, the poor teachers of California, are losing their purchasing power in retirement. So, is it smart to own bonds? And you can see here how as interest rates, this is inverted, go down, as the returns on those fixed assets for pension funds go down, the liabilities go up and up. And if interest rates are 2–3%, how can you achieve these expectations? So state and local governments still expect a 7% return for their pension funds. S&P 500 companies have lowered it to 6, but how are they going to get to 6 or to 7.5 with negative likely returns on stocks, long-term real returns, and certainly negative returns on bonds. And Dalio says that cash is trash, but equities are even trashier. Because if we take a look at Grantham's 7-year outlook for real returns, you can see that US large returns is projected to be down 7 years at 7%. That's more than 50% for real returns. International, a little bit less, and then only emerging markets and especially emerging value can give you positive returns. Good that I'm invested here. This is all what you need to know for macro investing. Of course, then it goes deeper to understand emerging value, etc., etc. But I'll switch to those videos in the coming weeks. Plus, Ray Dalio says, for real returns, own real assets. And again, emphasizing how everyone is long everything, money and credit push things up, the Fed already now, the market, as I'm filming this, the market is extremely exuberant today on positive news, bright spots in retail, so all good, mortgage rates go down, so very, very good for the market, and everything looks again good. Everyone is long and everyone needs things to just go up. The Fed needs the market to go up and everything goes up, but Ray Dalio warns us again that there will be negative real returns because, as he said, there will be a lot of sellers. So they are telling us, don't buy the dip, buy real assets. But the economy is still doing good. Numbers are good. Today the stock market is up. I don't know how it will be when this comes out on Saturday. Maybe tomorrow it will crash 3%. Maybe it will go up even more. You never know. Then crash on Monday. It's a crazy market because everyone is looking for that direction. But let's focus on the fundamentals. The warning is that there might be stagflation, so high unemployment, high inflation, and slow or negative economic growth. So this is what has been the case in 1974, 75, and 78, 1982 with recessions, and that was a very bad time for markets. If we look at the 100-year chart for the Dow Jones, you can see here how those periods of stagflation with recessions have been very, very bad for the stock market. So from 8,000 points inflation, so real returns, almost 9,000 points in 66, the market went down to 2,420 points. That's what, a decline of 70% in 15 years in real returns. Of course, if I adjust this for inflation, then we can see that businesses were flat for a lot of time. So this is again 15 years, no nominal returns, but also no real returns. Real returns only came back from the bubble here, the Nifty 50s, only came back to positive almost 30 years later. This is what Ray Dalio is warning us. And even ARK is up today, but over the last 6 months is down significantly as those pockets, as those bubbles start to deflate. But even more important than these high-flying names is this. Look at the yields again, like for the 10-year Treasury, for Italy, the 10-year yield is going higher and higher. And when these yields go higher, this is very important, because if you look at the bond market, it is a 130 trillion market globally. And compare the yields over the last 4 months. So US up almost double, global double, Germany up 20 times as it went from 0 to higher, UK double, Italy more than double, Spain 5 times up. On high yield, junk bonds double, so emerging market debt, okay, not that much, but this is really significant because now you need a 7% return to issue junk debt while it was 3.5. This will mess with a lot of countries and companies. And the problem is that with higher rates, many people will be selling this debt, and that will have huge repercussions on a lot of things. pension funds, etc., etc. And many have looked for protection within alternative assets like cryptocurrencies, but you can see here now especially that it was all a momentum play, all an inflow play, all a play on this goes up, let's buy more, let's go into, and then more and more exuberant stories about why you should own it. And now that there is, let's say, a little bit of a liquidity crunch, especially with those overexposed to tech, to growth, to all, this time is different, the world is going to change, you can see that this is not really protecting anyone from what's going on in the markets, and that this was also a bubble now slowly bursting 50% down. But I would not be surprised. That is the risk. Anything can happen with this crazy currency or whatever it is, can go 10x from here, but can also return to lows that we have seen in the past. Of course, the Nasdaq also deflating a little bit, down 28%, so bear market there. And it all depends on the value at some moment in time, because this is really insane that an index like the Nasdaq goes up, what is this, 9 times, but here at the peak 10 times. So that's really, really amazing. At some point when it comes to investing, it is all about price and value. For example, if we take a look at Apple stock, also did really, really well. What's that? 4x over the last 4 years, so really, really great. But when it comes to long-term investing, you have to look at what it really offers you. The price-earnings ratio is now just 23, so the return should be there around 4 or 5% plus the growth. Warren Buffett really likes it, so he started buying more at 150. This is investing, not the hopes this should go up because it should go up and you are stupid if you don't buy it, but this is investing. They make 100 billion per year, market cap is 2.3 trillion, price earnings ratio 23, for a return of 4.5% plus the growth. You have my Apple video if you're interested more. And you never know where the stock will go, up or down, but you know at what point something fits your investment requirements and financial goals. So this already looks more like value. This can still be bubbly territory, and especially this. So the answer is to invest in real assets. What the hell are real assets? Real assets are physical assets that have an intrinsic value due to their substance and properties according to Google. And what Ray Dalio says, not someone's debt. When you look at bonds and the market, it's all about leverage financial. Someone's debt is theoretically another person's assets, but not when that is worthless and crashing. And when it comes to, let's say, real assets, I also think that many companies are real assets, many companies are businesses. So this is Archer Daniel Midland's. Of course, when everything goes up, real assets go down, because who cares about real assets? But I've made an analysis of the company a while ago, so those who enjoyed buying a food company, real assets, something that you need, did really well. And there is another video, it's commodities, so it is much more volatile, much less stable than Archer Daniel Midland's, but it's still again mines and real assets. So again, a way to be exposed to real assets through owning businesses. But if there is a recession, this will crash like everything else, and even more from current levels. And then the message is, Ray Dalio says diversification, Warren Buffett says own businesses with pricing power. So that's something that you have to see what best fits you. Of course, Warren is the best ever. Ray Dalio went bust in 1982. Okay, so he has learned the importance of real assets, but I would conclude that real assets, the best investment, that's value investing. And that is why value investing is totally dead when this is happening. So value investing is over because this time it's different. But of course, now everyone looks for value, real asset and investments, but I think that the only thing that works, no matter what, all the time, over the long term, over the market going up, but also when the market goes down, that is value investing. So if you enjoy value investing, value that like button, consider subscribing if you haven't. Tomorrow we'll put all these videos that I make into a perspective of strategy and investing messages. Thanks for watching, see you tomorrow.